Today on the Purpose-Based Retirement, the biggest concern facing retirees today and how you can manage your portfolio during the next major market downturn. We have a question from a viewer about how much cash you should be keeping in the bank, and is your advisor keeping you on the cutting edge of money management?
Welcome to the Purpose-Based Retirement with certified financial planner practitioner Casey Weade.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience, helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you faced, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Welcome to the Purpose-Based Retirement. I'm Lee Kelso here with Casey Weade, certified financial planner and the president of Howard Bailey Financial. Now, if you watch this program regularly, you know that Howard Bailey focuses mostly on people who are near or in retirement. That's their primary focus. So who better than Casey, meet with these guys all the time, to tell me what is the biggest concern that near retirees or retirees have today?
Well, the biggest concern that retirees have as they step into our office is what are you going to do during the next major financial crisis, the next major recession, the next depression even? How are you going to protect my life savings against these major fluctuations in the market that they've had to endure over the last 20 years? They've experienced, a lot of the people we've met with have experienced losing half their life savings and having to get back to even over a several year period of time, and they don't want to have to go through that again. We had a gentleman here recently that came into the office, and this is why we decided to have this segment, is he stepped into our office, he met with Marshall Johnson, one of our financial advisors, our vice president, and he said to Marshall, he said, I met with my current advisor and asked him what he was going to do to protect me during the next 2008. Unsatisfactory answer. He said, sit on your hands, everything will be okay. Look, we came back last time, we came back the time before that, the market always recovers, so we don't have to worry about that. Well, this guy's at a different stage in his life, right? Now he is worried about that because he has different needs for those funds than he did last time we had a major market pullback. And then he met with another advisor, and that person gave him an unsatisfactory answer. He shared with him how they were going to be able to time the market and provide tactical money management, and that's just not what he was comfortable with. So without a doubt, the biggest concern of retirees is, what are you going to do to protect my life savings during the next major market meltdown?
And it's got to be coming. I mean, we're at the end of the longest bull market in history, right? And so I'm seeing an increasing number of financial professionals talking about a 20 to 40% decline not out of the question.
Right.
So how do you protect against that?
Well, when we ask why we need to protect against that in the first place, the reason that retirees have this concern that they didn't used to have is because now they have different needs than they had before, right? If you had $1 million and you retire, now it's $500,000, or you had $500,000, now it's $250,000. Add up all the value of your investments. What if it's cut in half? Does that change your life? It probably does. If it increases by 50% or doubles, it probably doesn't change your life. Now it's about protecting that life savings because we have immediate needs. We have income needs. Every single month we need to get that paycheck. So if you say I just need to sit on my hands, where am I going to get that paycheck from if it's not going to be able to come out of my investments? What if I have an emergency? What if I have long-term care needs? What if I have a major health care expense? Where are those funds going to come from? Because, hey, I was told I'm not supposed to sell low. I'm supposed to buy low and sell high. So now what do I do? This is why it's the biggest concern of today's retirees, and there's different approaches to that. One of the approaches that this gentleman that came into our office mentioned was timing the market, which is a tactical strategy. So if you pay attention to Vanguard CEO John Bogle, if you pay attention to Warren Buffett, the Oracle of Omaha, these are buy and hold investors. They're not tactical money managers. They don't believe that you can time the market. They are buying and holding a diversified portfolio of value and going through the ups and downs in the market, and that's not something a retiree wants to do with their entire life savings. So a lot of these tactical approaches have come into play. And the reality is all these tactical money managers that are supposed to be timing the market, they get it wrong sometimes, and they call this getting tail whipped. Eventually they get hit pretty hard, and you might see them have some pretty bad returns and some pretty good years. And I wanted to share with you a few different examples of some of the top tactical money managers in the world. These are PhDs, CFAs. These guys know exactly everything about the market that you and I don't, and I want to walk through what's happened. And they've all won national awards years after years, and these are some of their actual numbers. This is a tactical money manager that returned 17% last year, but look at 2015, down 4%, the market's up 1. 2011, down 4%, the market's up 2. 2008, down 20% versus the market at 37, not bad. This is another manager that's actually won more awards than the last tactical manager that we discussed, and it's due to the long-term average rate of return, and part of that 122% return they saw in 09. 2008, no losses. That's pretty stellar because not too many people can say they didn't suffer any losses on a calendar year basis for 2008, but then we see in 2017, markets up 22, they're up 2%. We look at 2015, markets up 1, they're down 15%. They fell on their face. You have to be careful when you're sitting down with a financial advisor that can't wait to show you their historical returns. You want to know if those are real or not.
What are the options if I can't trade in and out based on all the smartest people in the room? What's the plan?
What we need to do is you step into retirement, we need to make sure that you never have to worry about panic, you never have to worry about concern because you have a plan for the worst, and that's called a purpose-based retirement. And that starts with planning for all those areas that you can't live without, right? You know, that's what retirees have a concern with. My million turns into 500,000 and I have an emergency. This is why we have a liquidity bucket to go to for emergencies. My million turns into 500,000 and I need income. This is why we have guaranteed income to last the rest of our lives, so we don't have to sell when the market's low. Now, our investments go in that growth bucket, and there's going to be some volatility there, but we've bought ourselves time in order to endure some of those ups and downs, and then we've got a plan to take care of their rest, the estate, right? This is our legal documents, our insurance, whether that's taking care of long-term care needs, maybe even maximizing the estate, minimizing taxes. It's those 4 areas. If we have an emergency fund, we have secured income, we have a healthcare strategy in place, then next time the market has a major pullback, we don't get concerned. We don't have to pick up our phone and call our brokers or advisors and tell them to liquidate the portfolio at possibly the worst time because we don't need the funds. It's like we're 30 and 40 years old again on that piece of the pie. I understand.
So the bottom line here for me is I've got to make sure that the investment advisor I am working with is in sync with my needs and understands where I'm at. I'm not playing his game. He's got to be playing my game.
Right. We have to be stepping away from that accumulation advisor that has been focused purely. I mean, I hire advisors all the time that come from that world of investments and growth and accumulation at all costs. Sit on your hands, the market comes back. And the reality is it takes a lot of retraining in order to get those individuals to stop thinking about accumulation at all costs and start thinking the way a retiree wants you to think: protect my life savings and give me an income I can't outlive.
Yeah. So are you working with someone who is on playing your game, or are you being forced to play theirs? One way to find out is to be one of the next 10 callers who pick up the phone right now and give us a ring and get on the calendar for a complimentary review of your retirement plan. Casey or a member of the Howard Bailey team will sit down with you and review to find out what kind of fees and expenses are you paying. Are there tax opportunities you're missing? Are you taking way too much risk for where you're at in your investment career? And what about that lifelong income? Is anybody planning for that? Those are important questions, and questions go review in this complimentary review of your financial plan. If you're one of the next 10 people who call right now and make an appointment with Howard Bailey Financial to start your own purpose-based retirement. Okay, we're back in just a second with questions from viewers. Hope you're with us.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
The highest educational achievement for a financial planner is the Certified Financial Planner certification. At Howard Bailey, all of our frontline advisors are CFP practitioners. Certified financial planners have been thoroughly vetted with the right education and experience to coach you through the complexities of your retirement. Getting to retirement, that's really the easy part. Find someone with what it takes to get you through this next stage of your life. Would your financial and retirement affairs benefit from a higher level of insight and care? Call us now to find out.
And welcome back to the Purpose-Based Retirement. This is the point in the program where we answer your questions, and we're going to start today, Casey, with Beth and her question.
I don't understand the big deal with just taking 4% per year from all of my investments during retirement. Why should I spend some and not the rest? How do I make that determination?
Well, Beth, that's a great question. I think there's two things that you need to be thinking about. This is how most people do their retirement plan. This is what William Bennigan, a financial advisor from California, won some big awards for. His work in creating the 4% withdrawal rule. We just take a portfolio of 60-40 stocks and bonds and we draw 4% out of it every year. However, that's come into question due to a couple reasons. And that first one is market risk, or sequence of returns risk, which a lot of retirees experience from 2000 through 2008 and even beyond that, which is taking a major loss during a bad period of time and violating the #1 rule of investments. We're supposed to be buying low and selling high. And if you look at your investment portfolio, there should be some things that aren't doing as well as the others, and that is just diversification. If you're just selling levelly across every single one of those different investments that you have in that portfolio, you will be violating that #1 rule of investments, because you're going to be selling something at the wrong time. You need to be selling out of those things or taking distributions out of those things very strategically. This is why in a purpose-based retirement, we always have some place to go for that income. During a rising market, you should be selling out of those assets and locking in gains of those equities or those positions that are doing very well, locking in gains as you take your income distributions. If the market pulls back, you can stop drawing on those assets that are up and move over to what are most likely the lower yielding assets and more protected assets and start using those things for income. So one thing to keep in mind is just the market environment that we're in and making sure that we're drawing things out at the right times according to market conditions or economic conditions. The next thing to keep in mind may even be a bigger deal, and that is the tax situations. So the taxation of those different accounts and what the ramifications are of drawing income from those different places. You may want to take a blended income rather than taking it all from tax deferred IRAs or 401ks. You may want to take some from your tax deferred accounts, some from your tax free, maybe even some from your taxable. You may want to blend those different things in order to keep yourself within a certain tax bracket or avoid Medicare premium increases or paying Social Security taxes. Let's say, for instance, that you have a $50,000 taxable income, but you'd like to have $100,000 in income every year. So if you take $30,000 from your traditional IRAs, that'll max out your 12% bracket. Let's say you're married filing jointly. Then you take the other $20,000 that would push you in the next tax bracket from a tax-free place, so you don't get pushed into that next tax bracket. That's just another thing to keep in mind. So market risks or economic factors, as well as what's going on in the tax rate environment and the taxation of those individual accounts. Those are things that should be kept in mind. This is why we do income planning. This is why I'm a retirement income certified professional. There's only one area you can go for education when it comes to retirement income. I have that designation because it's very new. It's something that's only been around for a couple of years. Most advisors are just trained in investment management and trained to do what? Take 4% out of each one of these accounts every year and everything should work out fine. Run your Monte Carlo simulation and we'll see what those odds of success are. If it's above 90, we're doing pretty good. I think real retirement income planning goes much further than that.
Thanks for your question. Let's get to New Haven and Neil. Go ahead, Neil.
I have a significant amount of after-tax money as well as tax-deferred accounts, and I've always planned on spending my after-tax money first. But I was wondering, how do the new tax laws affect those plans?
That's a great question, Neil, and it affects it greatly. What we like to say right now in the Howard Bailey office is that taxes are on sale or Roth conversions are on sale. I'll say, one of the things we're doing a lot of right now, more than we have in years since we saw some significant benefits out of doing Roth conversions several years ago. Now we're in one of the most significant changes that we've ever seen when it comes to tax rate changes, and this means taxes are on sale, Roth conversions are on sale. And rather than deferring those tax deferred accounts into the future, we might want to start doing distributions from those things today, or even doing Roth conversions out of those tax deferred accounts and taking advantage of the tax rate environment we're in. We had a couple in just the other day that this is one of their biggest concerns. They said, right now we're 73, 74 years old. We got $1.3 million in IRAs. We're sitting on about $50,000 a year in RMDs, required minimum distributions. It's creating generating significant taxes that they don't want. They don't need those dollars. They don't want to pay taxes on those dollars. And now they know someday they're going to be passing on this big old taxable thing to the next generation, and they don't want it to be a burden on the next generation. What we were able to do is build together a plan that allowed them to fill up their whole 24% tax bracket. If you think of what happened about tax brackets over the last few months, if we look at where you used to be up to about $77,000 and a 15% rate, now 12%, then we went into the 25% rate beyond that up to about $150,000 in taxable income. Now that area is 22% and it goes 24% all the way up to $315,000 in taxable income. They will be completely tax-free within the next 5 years before 2025 and leaving behind a completely tax-free asset that'll actually be bigger, substantially bigger than what they would have left behind had they just deferred those dollars and reinvested them on a taxable basis.
Wow, a tax-free legacy. That's a pretty nice gift.
Not to mention tax-free income.
Absolutely. Let's get to Joy up in Angola. Go ahead.
Hi, my husband and I are in disagreement about how much to keep in the bank. I want 5 years of expenses and he only wants 6 months. So how can we both win?
Well, Joy, marriage is about compromise, and I think that compromise needs to start with a plan. And if we really know why we have that much money in the bank or how much we need in the bank in the first place, that can help make a very logical decision out of this. So once we build that plan, we may decide that we need a portion of those dollars that need to be invested in order to generate retirement income, and in order for that plan to be successful, it may be more or less than what you're thinking. So let's say you're spending $50,000 a year, you want to keep $250,000 in the bank. Well, let's say we set aside $50,000. That's our emergency money. That leaves us with $200,000. We take that $100,000, half of that, and that needs to be part of the retirement plan. So we have $100,000 that goes in a retirement plan, $50,000 stays in the bank. We're left with $100,000. Maybe we could leave it in the bank, but there's things that we can do today to do exactly what you probably want that money to do, which is stay liquid, stay safe, and be just accessible. We can take that $100,000, we just did this for another couple, set it in a place where it can grow better than the bank, stay completely liquid, we can have it back at any time, but now it'll provide $500,000 in long-term care benefits should they ever need the funds. So that solves another need or another hole or another crack in your plan by just moving some of that cash to another place, retaining the same benefits and picking up additional benefits, and putting together a real plan based on logic that allows us to reach a compromise as a couple.
Smart move. I think that sounds like a great idea, and it's something that you might not think about if you weren't listening to the Purpose-Based Retirement or somebody with a level of experience that Howard Bailey can bring. And that's why I want you to be one of the next 10 people to pick up the phone and call now and ask about a complimentary review of your entire financial and retirement plan. It's a chance to learn more about your money so you can make really strong decisions for yourself going forward around everything from taxes to long-term care and legacy planning as well. Those are things that will be covered in this retirement evaluation, and you'll get a chance to sit down with either Casey or a member of the Howard Bailey team and learn more about exactly what a purpose-based retirement can mean to you. So hope you're one of the next 10 callers to call the number on the screen right now and ask for that complimentary review of exactly what's going on in your retirement plan. Let's get to our question of the day, and we want to ask about exactly when was the first stock exchange established. Casey has the answer when we come back.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
The highest educational achievement for a financial planner is the Certified Financial Planner certification. At Howard Bailey, all of our frontline advisors are CFP practitioners. Certified financial planners have been thoroughly vetted with the right education and experience to coach you through the complexities of your retirement. Getting to retirement, that's really the easy part. Find someone with what it takes to get you through this next stage of your life. Would your financial and retirement affairs benefit from a higher level of insight and care? Call us now to find out.
I had no clues to the answer of today's question of the day. Hope you did a little better, and I know Casey has the correct answer. When was the first stock exchange established, Casey?
Well, Lee, the first stock exchange was established back in 1602. The Amsterdam Stock Exchange was created by the Dutch East India Company. And since then, over the last 400 plus years, we've seen an evolution in money management to the benefit of the individual investor, allowing investors to get more diversified, better professional management, better tax efficiency, and most importantly, lower fees and expenses. I want to walk you through what that evolution has looked like and where we stand today with the latest iteration of managed money portfolios. So we go back to the 1600s, we have the introduction of stocks and bonds. When we look at individual stocks and bonds, we knew what we bought. When we bought that stock, we could pull that stock certificate out and actually look at the certificate. We had transparency. We knew what we owned. We also knew the tax benefits of that, the pros and the cons. We knew when we bought it, what our cost basis was, what our holding period was, if it was going to be long-term capital gains, qualified dividends. We had the ability to control our taxation and give us that tax efficiency. The downside was it was difficult to get into those individual stocks and individual bonds for the average investor. Unless you had what today would be millions of dollars, you couldn't create a diversified portfolio of stocks. You couldn't create a diversified portfolio of bonds because you just didn't have the purchasing power to purchase, on the average, more than one or two individual stocks or one or two different issues, and you didn't have professional management. Again, unless you were a very large investor, you weren't getting the oversight of a professional money manager, and you were going in blind. Then along came mutual funds. In 1924, the first mutual fund was introduced. Now you could get that professional management and diversification at a much lower dollar amount. So now in today's dollars, you could have a couple $1,000s and get a completely diversified portfolio of individual stocks or individual bonds that could be managed by a team for your benefit. This is a great thing still today for smaller investors, like my son, for instance. I've got a 3-year-old with a 529 that has a couple $1,000s in it. He can't go out and get a professional money manager to manage the portfolio in that smaller dollar amount, so he has to invest in this mutual fund that has a downside. Yes, he gets professional money management, he gets diversification. Unfortunately, he ends up with higher fees and expenses, tax inefficiencies as well. And that is that if we buy into a mutual fund, we don't actually own any stocks and bonds. We own that fund that has built-in tax liability. This is exceptionally dangerous at the tail end of a bull market when a lot of these mutual funds are continuing to build up those capital gains in the fund. If the market pulls back right after you buy in, those gains could be spit on out to you without you ever actually experiencing any of that gain in the first place. We're also losing that transparency. We don't all the time know exactly what stocks and bonds we hold and exactly what fees and expenses that we're actually paying. The Wall Street Journal did a study that found that the average expense ratio of your mutual funds about 1.4% a year, and if we include the hidden expenses, that typically doubles the number of expenses inside of the average mutual fund. So then came along ETFs, exchange traded funds, and separately managed accounts. Separately managed accounts were introduced in 1970, and what this allowed us to do was essentially go straight to the mutual fund manager. We had the ability to go straight to that manager and pick the best in breed manager to manage my portfolio for me so that I could actually own those individual stocks, those individual bonds, have them professionally managed, get diversification, have greater tax efficiency because I've got my cost basis and I can control it in each one of those individual positions in the account, and I can minimize my fees and expenses, and I don't have any hidden fees and expenses for that matter. It used to be that it would cost us the ability to get into one of these accounts would be hundreds of thousands, if not millions of dollars. Now today those minimums are much lower, and that natural transition comes around $100,000 to $200,000 in investable assets. Now we can step away from that retail world of mutual funds into the institutional world of separately managed accounts. Still, with separately managed accounts, we had a downside. If we wanted to have a fixed income manager, a large cap manager, an international equity manager, if we wanted different managers that had their different specialties, we would have to have separate accounts for each one of those portfolios, and that made tax time kind of confusing. but here just last year, unified managed accounts were introduced. This is one of the most exciting things that I've been wanting to share with you for some time, is because unified managed accounts present such a neat and unique opportunity for individual investors today, providing us all those benefits of having a separately managed account, but all under one roof. So now we can have multiple money managers managing our portfolio for us, giving us diversification, giving us tax efficiency, minimizing fees and expenses, having transparency, and consolidation, simplification, so we have all those things in one account with one account number and one 1099 to file for that matter. Much greater efficiency. So you might be asking yourself, why haven't I seen this from my advisor? And it's because it takes some time for those big old companies, those big brokerage firms that have been around for a really long time with layers of bureaucracy, to turn that ship around. We've seen this evolution from individual stocks and bonds to mutual funds, providing greater diversification with its downside to separately managed accounts, allowing us to go straight to the source, to unified managed accounts, simplifying things that are really bringing us back to where we wanted to be in the first place. We wanted to own stocks and bonds, but we wanted to have the ability to diversify as well, and that's what UMAs have allowed us to do. So you have to jump off this big old cruise ship that you have right now, because that big old cruise ship is the big old brokerage house out there that's not bringing you the latest and the greatest opportunities. Because think about turning this thing around. If you forgot something at the dock, it's probably going to take hours to turn this ship around. You may not even get out of port until the next day. That's how slow some of these big firms move when there's a new opportunity on the horizon. This is what you want managing your investment and your portfolio and your life savings. You want someone that can always bring to you the best in breed and the best options as soon as they come out, not a year, 2 years, or 10 years after we've had these options on the table. A lot of these large companies are offering the same old products they offered 20 or 30 years ago because of the revenue sharing agreements that they have set up with these mutual fund companies and with these insurance companies. Let's get on the jet boat and get that retirement in the direction that it needs to be headed.
Yeah, I like the idea of having my retirement on a jet boat. That's a good plan. When should I start thinking about that, though, Casey? If I'm a younger investor, do I talk to you when I'm 30 years old? Can you help me then, or do I wait later?
It really depends. So I've got individuals that are, I've got a new family I just started working with that are 35 and I believe 42. They're some of my youngest individual clients. However, they were managing their funds on their own. They had a little inheritance, and it became a little concerning that they didn't have professional management on that portfolio. We were able to move them out of Vanguard managed funds and also some of their 401k dollars over to our managed portfolios, providing them those unified managed accounts, providing them professional management and also PhDs and CFAs to manage that portfolio on a daily basis, not somebody just sitting down the road with 5 people managing their portfolio in their office. These are professional money managers. That's all they do. We provided them with a lower cost than they had before, and they've got professional money management. That typical transition happens somewhere around $200,000 to $300,000 when we actually have the ability and the purchasing power to step into that institutional world of money management.
Well, if you'd like to take a look at whether or not that might be a good fit for you, here's an opportunity. I hope you'll be one of the next 10 people to pick up the phone and call Howard Bailey Financial and request a complimentary review of your entire financial and retirement plan. A chance to sit down with Casey or a member of the team and take a look at how are your accounts structured. Are you paying more in fees and expenses than you should? Taxes? What about health care? What about a lifetime income? All those things, are they provisioned for in the plan you currently have? If not, should they be, and can they be? Questions you'll learn more about as you sit down with either Casey or a member of the Howard Bailey team after calling the number on your screen and requesting a complimentary review of your entire retirement plan. You can always visit howardbailey.com to learn more about the company, to request a copy of Casey's book, find out more about when this program will be seen, and keep yourself on path for a purpose-based retirement. We'll see you next week.